right, today we're going to dive into something called VTM, which stands for Volume Trend Microstructure. Now, I want you to think of it like a pair of X-ray goggles for the market. It's a system that's designed to show you where the institutional smart money is placing its big bets before those bets are big enough to actually move the price.
So let me kick things off with a question for you. Are the price charts you're staring at every single day really telling you the whole story? Because the whole idea we're going to unpack here is that what you see on a standard chart, well, that's just the final score. It's not the play-by-play of how the game was won.
And this slide just illustrates that point perfectly. On the left, you've got the typical retail view. Price went up, the end. It's totally reactive and it has zero context. But then you look on the right, and that's the reality that VTM is trying to uncover. It's not just that price went up, it's how it went up. You can see this persistent high-conviction buying pressure building up inside the candle. It's literally detecting institutional accumulation before that massive breakout actually happened. This right here, this is the core belief, the entire thesis of this whole framework. It's such a simple idea, but it's incredibly powerful. You know, most people are absolutely obsessed with price, but VTM argues that volume is the real engine driving everything. And if you can understand the cause, you stand a much better chance of anticipating the result.
So, how do we actually follow these institutional footprints? Well, it all starts with understanding a really crucial inefficiency in the market. See, large institutions, they can't just click a button and buy a billion-dollar position. If they did, they'd instantly spike the price up against themselves. No, they have to be sneaky. They have to build their positions carefully, piece by piece, over time.
Now, what's really fascinating here is this concept of the alpha window. It's the perfect visual for the information gap in the market. Way back at T-3, the institutions start quietly building their positions. Their huge orders start creating these little clusters of volume that most people would never notice. But by T-1, these little anomalies have built up into a clear pattern. And that's exactly what VTM is designed to see.
Let's break that timeline down a bit more. The big players get in between T-3 and T-1. The VTM signal fires right inside that alpha window. Then, at T0, the price finally explodes upwards, and that's when most trend followers finally get their confirmation signal. By the time we get to T+1, retail is chasing the move, and the real opportunity? It's long gone. And that's the whole game, right? This system is engineered to give you a signal 1 to 3 bars before that price confirmation ever shows up.
Okay, so if we want to spot what's happening inside that alpha window, what do we need? Think of VTM as a detective, all right? It's got this forensic toolkit that it uses to find clues hidden deep inside the volume data.
The first and honestly the most important tool in the kit is something called the Hawkes process. And I know this looks complicated, but the idea behind it is actually pretty simple. A massive institutional order can't just be executed in one go. It gets chopped up into smaller pieces. The Hawkes process models this, showing how one big initial order creates a kind of statistical echo, which makes it much more likely that similar orders are going to pop up right after.
Yeah, to put it simply, it's what's called a self-exciting process. A good way to think about it is like mathematical memory. A big buy today makes more buys tomorrow statistically more likely. What it's really doing is modeling the persistence of an institutional campaign that's unfolding over days, not just in one single moment.
The next tool is all about context. I mean, think about it. A random volume spike on a 15-minute chart, that could be anything, right? It's just noise. But what if that same spike is part of a bigger pattern on the 4-hour chart, which in turn confirms a major trend on the daily chart? That's the information cascade. When signals start lining up across short, medium, and long time frames, you're not looking at noise anymore. You're looking at a coordinated institutional campaign.
This whole process is kind of like pouring raw market data through a really fine filter. The system calculates what it calls a consistency score, and when that score gets above 0.7, that's the confirmation. It means all 3 time frames are singing the same song. This is the final filter that separates a real institutional footprint from all the random noise of retail trading.
So what fingerprints is VTM actually looking for? Well, it really boils down to these 3 core patterns. You've got hidden accumulation. That's when the price is flat or even falling, but behind the scenes, volume pressure is quietly rising. That's smart money buying weakness. Then there's hidden distribution, the exact opposite. Price is rising, but buying pressure is actually fading away. And finally, structural divergence. That's any major mismatch between price and volume, and it's a huge red flag that a big change might be just around the corner.
Now, finding a single clue isn't enough.
A detective doesn't solve a case with just one clue, and VTM doesn't either. The real power here is how it combines all these individual signals into a single, high-conviction score. It's all about building a solid case to cut through the ambiguity and the noise.
So let's see how this case actually gets built. The system uses what's called a confluent score, and the foundation of any good case is finding one of those core institutional base patterns we just talked about.
And boom! Finding a clear hidden accumulation or distribution pattern, that's your smoking gun. It's the strongest piece of evidence, and it gives the case a really solid start with 30 points right off the bat.
But it doesn't stop there. Next, the system layers on more evidence. It starts looking for a structural misalignment, a divergence between what the price is doing and what the underlying volume flow is actually doing. Spotting that adds another 20 points to the score. Now the case is getting really strong that something big is happening under the surface.
And here's the whole thing put together, the complete scorecard. You can see how the base pattern, the divergence, and other technical factors all add points to the total score. But what's really clever is the dynamic threshold. In a calm market, a score over 40 might be enough to trigger a signal. But during really high volatility, the system automatically demands a higher score, over 60, to filter out all that extra noise and avoid false positives. It adapts to the market's mood.
So we've seen the theory and we've seen the scoring. But how does this all translate into a complete, actionable system? This is where VTM really shines, by integrating into a bigger trading architecture. So the full system, it's called Duobase V2, and it's built in layers. Layer 1 is your basic trend-following algorithm. It's like the scout. It looks at the price and tells you the general direction of the market. But Layer 2, that's the crucial confirmation layer. That's VTM. It's like getting the go-ahead from headquarters, analyzing the volume to tell you if that trend is actually real and backed by institutional conviction.
And this is what a high-conviction playbook actually looks like in practice. It's basically a checklist. First, is the price trend bullish? Yep, check. Second, is there institutional flow, like a hidden accumulation pattern? Yes, check. Third, is the combined score high enough? It is, check. And finally, fourth, is the broader context right? For instance, is volume strength coming out of an oversold zone? Check. When all four of those things line up, that's when you have a high-conviction signal.
All right, that's the system. But here comes the most important question of all. Does it actually work? I mean, why should anyone trust it? Let's take a look at the data.
This chart right here really says it all when it comes to performance. Backtested data shows that a simple trend-following strategy spits out a ton of false signals. But when you add VTM as that volume confirmation layer, it just filters out so much of the noise, leading to a 55% reduction in those false signals. That means you're avoiding more than half the bad trades you might have taken otherwise. And we all know, avoiding the losers is just as important as picking the winners.
So what does it do for your winners? Well, the analysis shows that for reversal trades, which are notoriously hard to get right, adding VTM's volume analysis can improve the win rate by a measured 5 to 8%. It gives you the conviction you need to act on a potential bottom or top when the price action by itself is still totally ambiguous.
So, to wrap it all up, this whole framework really rests on 3 pillars. You have microstructure, which uses tools like the Hawkes process to really understand volume. You have trend, which integrates all this analysis with a solid price-based system. And finally, you have edge, which comes from taking advantage of that information gap, that alpha window. So when you boil it all down, what VTM really gives you are 2 things: the discipline to wait for the pros to make their move, and the data-backed conviction to act decisively when you finally see their footprints in the sand.